The S&P 500 has nearly doubled in the last 5 years. Looking at the broader market, you would naturally assume everyone is getting rich. But for the vast majority of everyday people, that illusion shatters the moment they start trading. Around 75% of regular people who buy and sell individual stocks actually end up losing their money. Inside Wall Street firms, there is a specific nickname for casual investors. They call them capital donors. Instead of building their own net worth, regular investors systematically transfer their cash directly to the wealthiest 10% of Americans, who currently own nearly 90% of the entire stock market. We can map out exactly how this transfer happens by looking at this cyclical flow of capital. Most retail investors buy in right at the apex of social media hype. Then, when the inevitable market correction hits, they panic sell at the absolute bottom. It doesn't have to be a casino. While retail gambling fails, there are foundational, low-effort strategies that allow everyday investors to safely capture steady growth and win over time. But if you try to outsmart the market without a concrete system, you guarantee your money will simply end up in the pockets of the professionals on the other side of the trade. The standard entry point for sound investing is blue-chip stocks. You buy into massive, reliable companies with global scale, hold them, and collect steady dividend payments year after year. But tying your capital to a single company carries unhedged risk. If that one business falters, your entire portfolio takes the hit. Index funds and exchange-traded funds, or ETFs, solve this by letting you buy tiny slices of hundreds or even thousands of companies all at once. From there, you spread those investments across different sectors and global regions. If U.S. tech stocks drop, your international healthcare holdings might hold steady, smoothing out the bumps along the ride. This baseline strategy provides excellent stability, yet it completely lacks the extreme leverage and risk mitigation required to capture the massive scale of wealth commanded by the top tier. Moving up the ladder, millionaires do actually pick individual stocks, but they apply severe fundamental discipline. They research specific earnings metrics and long-term structural trends instead of chasing Reddit hype. Even with deep research, they know they can't perfectly predict the future. This diagram illustrates an options collar, a defensive shield used by wealthy investors. They buy a put option to establish a hard floor, legally guaranteeing a minimum exit price. At the exact same time, they sell a call option, establishing a capped ceiling. The premium collected perfectly offsets the cost, securing a zero-cost protective barrier. Wealth at this tier relies heavily on exact mathematics. It is less about timing massive gains and entirely about mathematically eliminating a total loss. Highly successful operators running their businesses rarely have active hours to watch daily ticker movements. Instead, they allocate their capital to hedge funds, private teams tasked with generating positive returns regardless of whether the broader economy is booming or crashing. The most exclusive tier of these funds executes quantitative trading. They abandon human intuition and rely entirely on mathematical code, processing massive arrays of alternative data. A quantitative algorithm will analyze real-time satellite imagery of weather patterns over the American Midwest, detecting even a slight drop in rainfall.
It calculates an impending agricultural supply crunch and automatically buys equity in global fertilizer companies a full week before Wall Street analysts even read the crop reports. A human being staring at a screen simply cannot compete with automated statistical matrices running microsecond arbitrage around the clock. When net worth crosses the 10-figure mark, external funds hit their structural limits. At this stage, billionaires build an entirely private, dedicated wealth empire known as a family office. This structure executes direct private equity placements, bypassing public exchanges to buy massive stakes in startups. Jeff Bezos ran this exact sequence by injecting capital into Google back in 1998, long before its initial public offering. Capturing these massive equity blocks requires immense pre-existing capital and elite network access. Peter Thiel utilized this exact closed-door advantage to turn a $500,000 angel placement in Facebook into over $1 billion in liquid cash. Inevitably, some investments lose value. This scale demonstrates tax loss harvesting. The family office uses an algorithm to liquidate a red, depreciating stock, realizing a specific loss. They then use that exact loss to perfectly offset and erase the tax weight of a green, appreciating stock. By continually rebalancing their equity base to wipe out capital gains, the family office operates inside an entirely detached financial ecosystem, playing a different game entirely than standard public market indices. The most powerful mechanism inside this fortress is a specific sequence designed to extract massive cash liquidity without ever triggering a taxable event. An elite founder will hold on to their core equity blocks indefinitely.
Instead of selling shares and triggering a massive tax bill, operators like Elon Musk pledge a fraction of their stock as collateral to secure enormous low-interest bank loans. Because debt is not legally classified as active income, the cash enters their account completely tax-free. The principal asset is never sold. Upon their passing, the entire portfolio transfers to their heirs through a legal mechanism known as the step-up in basis. The asset's cost basis resets to its current market value, legally erasing all historical capital gains. When the ultra-wealthy do choose to part with their stocks, they execute strategic donations directly to their private foundations. By donating highly appreciated equity, like Warren Buffett transferring billions in Berkshire Hathaway shares, they capture a massive personal tax deduction, matching the full market value, while bypassing the capital gains tax entirely. The top fraction of a percent utilize debt and charitable structures to permanently separate their actual spending power from their legally taxable income. The data reveals a clear reality. The stock market is a highly engineered system designed to sustain, insulate, and compound your wealth, rather than a primary mechanism to create it from absolute zero. Scaling your capital requires a sequential evolution. You master low-cost index funds to protect your baseline, progress to risk-hedged option strategies, and eventually scale your infrastructure toward private equity placements. You have to stop treating the market like a lottery wheel, where you hope for a lucky break, and start approaching it as a precise, multi-tier financial blueprint you can engineer. Raw information yields zero financial return without aggressive, real-world execution. Lock in your strategy, apply systemic daily discipline, and start building your machine.